State Farm is the last insurance company since the 2017 wildfires that really kicked off this attention to wildfire. They're the last insurance company to non-renew any customers. Up until now, they've been holding off on making this decision. No one wants to make this decision, particularly when you work so hard with your agents to bring new customers into the organization. And those agents, they get paid by commission. They only get paid on what they sell. Since 2017, every other company in California has engaged in some type of non-renewal. State Farm didn't. And they continued to hold on not only to their customers, but then they grew when so many other companies were either ceasing new business or restricting new business. State Farm continued to grow. And from 2017, where they had 17% of the market, to the end of 2023, where they had over 21% of the market, they grew precipitously. And in a state like California, as big as it is, to grow 3.5% in such a small period of time, that's unheard of. And State Farm's the market leader. They write over 20% of the business. They don't have shareholders, so they're not meeting a quarterly sort of investor call. They're what's called a mutual insurance company, which means they're owned by their policyholders. They don't have shareholders. So as the biggest company that has the most capital, that doesn't have shareholders, that doesn't have quarter-to-quarter worries, they continued to hold on to their existing customers and grow for a significant period of time, and they held the market together for a long time. But what they indicated in a letter to the insurance commissioner this week is that the capital that they held to support their business, because remember, insurance is a promise, and when you write an insurance policy, you have to make sure you have enough money to service those promises that you make to people in their moment of need. And so they sent the insurance commissioner a letter explaining this decision, and in that letter they indicated that they only have 30% of the capital today that they had at the end of 2016. So all this growth that they had engaged in, it was unprofitable growth, and it drained their policyholder protection fund. And even a giant like State Farm cannot ignore the fundamental laws of economics. What they expressed in a letter to the commissioner is things would only get worse, and they need a period of time to stabilize and ultimately begin to grow capital again so that they can consider at some future date the ability to grow. In the meantime, their financial regulator has indicated that they have to submit what's called a company action plan, which is a requirement under solvency regulations to explain how they're going to get out of this situation. And for the market leader to even use the word solvency is a significant thing. And ultimately, they have to be concerned for the solvency of the company, and they have to make sure that they can keep their promises to their existing customers. That's a very serious situation. The problems of today, their origins really are 10 or 15 years old, and the state of California just continued to ignore a problem as it grew and grew. And then when we got this newest insurance commissioner, he really inherited a terrible situation, not of his making. And so we understand now he's trying to figure a way out, a way forward for the insurance industry collectively and for State Farm in particular. But, really the issues that are plaguing the insurance industry and homeowners across the state, they really relate to a set of state regulations that was drafted over 30 years ago and that the previous insurance commissioner simply refused to update. And so we have a set of regulations where we're the only state in the United States that handles homeowners insurance in two very particular ways when we come up with the rates that insurance companies are permitted to charge. Because insurance, unlike most consumer goods or services, it's not as if an insurance company in California can just change their price. It's not like a gas station that gets to change the price on their sign whenever their underlying costs change. You have to go to the state of California and make a rate filing and go through the most complicated rate formula in the United States. And it takes anywhere from 6 months to a year to go through that process and get an approval to change your price through the state of California. As big as State Farm is, the number of homeowners affected by this decision is 29,000 policies. The rest of the policies are commercial policies. For instance, a landlord that owns a building where they rent it out. So you never want to make light of 29,000 homeowners losing their insurance. But at the same time, when they have a couple million policies, it's a fairly surgical action that they're taking. It's a relatively small percentage of State Farm's business, but it has a huge impact on the liability that is in their portfolio. And this action will help them make sure that they can service their existing or their remaining customers. So the problem is that Californians have gotten used to relatively low homeowners insurance premiums. And of course, in some areas where you look, if you compare the average to what some people in high risk areas pay, of course, they pay a lot more than the average. And they certainly wouldn't want to hear me saying that we're a relatively low premium state. But if you look at the average premium charged in California and you compare it to the rest of the country, we're a below average state. And that's on an unadjusted basis. And then when you look at the average premium paid in California compared to the average income we have in California, which is way higher than the average in the country, there's only one other state that's cheaper than California when you adjust it for average income, and that's Hawaii. So we're a relatively low premium state. That's been a conscious decision of the state of California for how they use their rate formula. And they've refused to update, a couple of pretty basic things that every other state has moved on and updated. So when we went into the big 2017 fires and then the 2018 fires, companies hadn't really been able to appreciably increase their prices in about a decade. And so companies were in already a big hole by the time the big liabilities of 2017 and 2018 hit. And so they were attempting to dig out of that. And of course, part of that means they requested the ability to charge higher amounts. But then once we had the pandemic and then the shortages in materials, the increase in labor costs, then we had the subsequent inflation. The cost to rebuild a home today is much higher than it was in 2017. And the reason that matters is because the claims that companies pay for a home lost to fire, you have to rebuild the home. So as home reconstruction costs have skyrocketed, that increases the losses that insurance companies pay. That means they have to charge more money in order to pay those bigger losses, and they're trying to catch up. But with this inflation, they haven't been able to catch up, particularly when it takes, it could take a year to get a rate increase. And even then, you might not even get the amount you requested. And so if insurers are not permitted to charge an adequate premium to service the highest risk communities, then they're not going to be able to serve those highest risk communities. And that's a terrible situation. And so in California, there's actually a right to fire insurance that satisfies the requirements of a mortgage lender. If you cannot get insurance through a regular company like State Farm, you can go to what's called the California Fair Plan. And the California Fair Plan, they charge rates like every other insurance company, but the only people who go there are people who cannot find insurance in the regular market. So this is a requirement of the state of California. Every insurance company, if they want to do business here, they must join the California Fair Plan, subject themselves to its rules and regulations. And if the Fair Plan runs out of money in serving the highest risk customers, whatever deficiency they have, they pass the hat among the insurance companies on a market share basis. Okay. So people who go to the Fair Plan, first of all, it's going to be more expensive because it's a high risk pool, as any high risk pool. If you have a health insurance policy where only people with pre-existing conditions, you're going to have higher claims costs out of that pool, and it's going to be more expensive to get health insurance through that pool. Okay. So the Fair Plan is the same thing, but only for property. And so if you have to buy from the Fair Plan, which no one should want to buy from the Fair Plan, it's always going to be more expensive because it's a last resort catastrophic fire insurance pool. It's guaranteed that you can get it and you can close escrow. So it's important. But the Fair Plan's been growing. It's growing on an unsustainable level. And at this point, it has well over $300 billion of claims exposure. And they don't have the ability to pay for a significant event that would happen in a fire risk community. And so as the FAIR plan grows and people are, if they're not able to get insurance from a regular company because that insurance company is having trouble with the existing system because we have very outdated regulations, then the only choice, instead of allowing the person to pay more, 10 or 15% more or whatever the number is going to be with a regular insurance company, they have to go to the FAIR plan and pay way more. And then if there's a huge fire and the FAIR plan doesn't have enough money to pay their claims, they're going to turn around to the very companies that said no in the first place, who are already going to have their other claims they have to pay in a big fire. And the FAIR plan is going to say, now give me money. So if there's a $3 billion claims event and the FAIR plan only has $1 billion of claims paying capacity, they're going to need $2 billion from the insurance industry. And they're going to turn around to State Farm and say, well, you write 20% of the market. Give us $400 million. And they just have to pay it under California law, right? So right now we're in this terrible race where we either fix the market and depopulate the FAIR plan and remove this threat of this huge assessment on the insurance industry, or the FAIR plan is going to have a terrible event and they're going to impair some companies when they ask for that money to pay for all those claims. So it's a terrible race we're in and we have to fix it.
If you haven't checked out CaliforniaInsider.com, we highly recommend you do that now because we're going to have a lot of news and videos there. And on top of what we have there right now, we are building a really big platform to cover what's happening in California so you can be informed. We're going to have more shows, more videos from all aspects of life in California. Go to CaliforniaInsider.com and we'll see you there.